I'm Greg Schnell, the Canadian technician, here to host the Market Buzz. This show looks at weekly setups across the U.S. market. Using the tools available on StockCharts, we'll look for long time frame trades. Please subscribe to my articles and Twitter feed to keep updated throughout the weeks. Okay, so we've got ourselves an interesting setup in the markets, and much consternation, I'd say, has been put out about the inverted yield curve, and I spent considerably more time on it this weekend than I would have expected. I sat down to write a quick article, and it took me 5 or 6 hours later. I was finally finished it. So I want to talk a lot about the inverted yield curve, and I talked briefly last week about recession watch, but I went through a whole bunch of the yield curve stuff. There's some feedback on Twitter, so I went through some of that, and so I want to talk about those things, and then we've got gold. So that's going to fill up our time slot very quickly, actually, today. So let's jump into it because I want to try and get through it all. So first of all, I wrote an article just on the weekend about the 3-month crossing over the 10-year. And so I just want to briefly roll through this article and discuss a couple of key points. One of the things that becomes obvious when you look just at the last 20 years was you had these compressions in yield, and then the market rolled over. So you had these really, and this is a 50% drop, and this is a whatever 50 or 60% drop, 1575 to 666, and then ran all the way up here, and we got up to this top, and now so far it unfortunately looks like a topping structure to me. So we're going to keep looking at that. But one of the things that I'm following, I went through and I put in, from this chart above, I took out all the other colors, but I wanted to focus on the points where the 10-year, which is in brown, and the 3-month crossed, because there was a lot of discussion about that last week. So anyway, I did that, and I worked through, and I briefly want to show you how to do that, because it's quite easy. And essentially what I did was I just went and I grabbed my chart list, and I said, okay, let's go make up some bond spread pages. And then I literally would just take a bond spread page and lock it in on a date and time. So these were, you'd set your select start and end, and you pick start and end, and then look at them. Now, one of the problems with 1980 was that was the top of the interest rate cycle. So we were up around 17% for all of you young people sweating about a 3% mortgage or a 3.5% mortgage. This was when I was trying to buy a house, when it was up at 17%. So anyway, the problem we have here in this particular case is that the interest rates were still rising, and at this point they started to fall, and Paul Volcker came in to try and tame inflation from the Fed. And so anyway, when you look at some of these going back, this is when we first started tracking the 3-month yield, and that was 1982. But anyway, working through these different ones, just picking different points in time. Here's 1988 to 1992, and you can see this compression in here, and then you have the S&P large cap, and when that compression started, so let's call it back in here, what happened was basically the stock market went flat for pretty much a whole year, and then came down a little bit and started to run back up. Now, this doesn't look very significant, but this 360 or 370 down to 300 was a good at least 20% drop, so call it 25%. Once the yield curve actually looked like it was improving, it was still in a problem position. So we've just gone through this part where it rolled over, and you can see back in 89 that was a continuous run up, and the market ran on for a few more months before things got ugly. Well, what I wanted to know is, when did the 10-year actually cross below the 3-month? And it was somewhere right in here, just real quick, and you can see that kind of started the range trade that we were in from May of 1989 going through to March of 91. So ended up being in this kind of square box area. Now you could say, well, it rallied for 2 more months. Okay, yep, it did, and a good 10% run, and so that was worth watching. But as you go through these, again, if we all think we're smart enough to pick the final high to the day, that's pretty hard to do. So anyway, I focused this article on the last 2 main turns, and I'll get into why that is in just a second. But anyway, in 2000, what we had was there was a brief touch here where the 10-year went below the 3-month and then bounced out. But this is kind of when they really crossed. And this blue crosshairs is when the 10-year actually started to make new 52-week lows in yield and a high in price. And even in any charting, we talk about a new 52-week high as something to pay attention to. So when somebody's starting to pay more for a bond than they have in the last 52 weeks, that's worth watching. And it starts to push down yields. Well, what we can see here in 2000 was it pretty much marked the final high. And then here's a close-up of the S&P in 2000. And we had this staggered topping structure where we hit a big high in March. You can see this was a big intraday reversal. And then the market pulled back. And then we spent a considerable amount of time trying to get back up through this level. And in September, which was this high right here, we kind of broke out briefly, spent a couple of days up there, and then fell away. In that particular case, the 50 hadn't crossed below the 200 in a long time. Anyway, it was a situation which was really caused by the tech crash, and then it kind of rolled across the rest of the sectors. Now, back in 2007, what happened was the 10-year crossed below the 3-month in 2006, and a lot was made of that. And then in 2007, it did it again. But we actually didn't start making new 52-week lows on the 10-year yield anytime in 2006, 2007, until very late in 2007, roughly November. And what you can see here, just looking at the price action on the S&P, was we had our high in July, then we tested it and broke out a little bit in October, made an immediate retracement, and then pulled back up and tried to rally back through that high and fell down. So zooming in on this, what you see is the January, February, March, then a huge rally, and then we kind of stall out on this rally, briefly break out at the right-hand side and then fail, try to rally back up, struggle at resistance, get back through it, try to make a higher high, nice needle nose way up here, and then it starts to build a little topping structure, rolls back down, tries to rally one more time. And you can see one of the things that's always interesting about these rallies is they have these big spikes in them where people are really trying to change the momentum, and somehow it just doesn't work. And then all of a sudden the market just kind of falls away. Now, while that looks like, okay, well, gee, that was dead obvious that it fell away. Well, look, it rallied all the way back to that same point just a few weeks later. And so you end up with this big topping structure. Now, in 2007, what you can see is really from, I'll call it May through the end of the year, we kept testing this prior level. And then in 2008, we had a big pullback. Okay, so let's go to present day. And the reason we're only covering these 3 points in time are because this is the only 3 times since the turn of the century that the 10-year has crossed below the 3-month. And here we are sitting, and on this particular day, Thursday and Friday of last week, we had the 10-year not only cross below the 3-month, but we also had a new 52-week low. And so I marked that with a crosshairs. So when we look at our market structure currently, you can see that we've been trying to break through this kind of level for almost a year. And on Friday, we had actually kind of rallied up and pulled back. And this started to look a lot like the ones we saw on the other pages up above. But we also have lower momentum here. So you have a higher high in price and lower high. And again, this is a daily chart, so I don't really want to use daily charts for my momentum calculation. But the problem we have is all of this resistance up around this level that we keep trying to get through and failing at. So anyway, when we place this all together, what we see is these new 52-week lows in the 10-year marked big reversals, and we'll find out if it's going to mark a big reversal. Anyway, so with all of that, I can't help but say that this concerns me that we're starting to build a major top. And then back in October 15th, I wrote this article on zooming out, which is about 2 weeks after what would end up looking like the final high in in 2018. So roughly right in here saying, is this the final high? And I still believe it is. We'll see if I continue to be teased by testing higher. But going through these articles, this was the Saturday article, and one of the points I want to make is when all of these upsloping trend lines break, it's an important place to be aware of. And this is a monthly chart. And you can see here we have a trend line on the Nikkei, and it's starting to break. And we had this trend line in here, and when your PPO broke, that was a clue the high was in. And in this case, we got negative divergence. In this case, we had, I wouldn't call it good negative divergence because it took a whole year and a half to make the second peak. So, and on a percentage price oscillator, it was still up at the same level, so I don't have a problem there. What I have a problem with was we were starting to break through the trend line again on the Nikkei. Now, here's the DAX, and again, we've broken some big long-term trend lines. This is the 09 trend line, and we broke it. And again, Germany's one of Europe's biggest economies. Japan is a very influential economy in Asia. So between those three, the US, Japan, and Germany, we broke the trend lines on all three. And on Germany, the monthly PPO is already going below zero. And what we can notice over here on the left is when it goes below zero, this is a pretty rare event. Doesn't happen very often, but when it does, it's worth paying attention to. So anyway, continuing on, here's Germany zoomed in on the current situation, and you can see this topping structure. And right in here, this was the October drop in the DAX, and what happened was that kind of corresponded with the S&P starting to break down late September, and then we've rallied back up perfectly to the neckline and to the 40-week moving average and to prior resistance. Like, there's all kinds of reasons here to be very, very cautious on the DAX. And so here we've got the Russell, and the Russell was underperforming back in September and started to speed down below everything. And then on the S&P, you can see we were right at resistance. On the NASDAQ composite, we were trying to get through this resistance line. And on the Russell, we tried, and that was 3 or 4 weeks ago. Now we're already making new 1-month lows on the Russell. So one of the charts that had been posted in one of the blogs was that the Russell was starting to underperform for the last 2 years, which is usually a problem. And it rallied back up. And then on March 1st, we said, start to watch and see if this starts to underperform. And sure enough, we had an upsloping trend line and it broke down. And if you draw the upsloping trend line in here or a little wider out and take a 3-month top in relative strength, it's starting to roll over. So the problem right now is the Russell's very close to breaking down to new lower lows, and that would be a big deal. But even on this weekly chart here, what we see is this indicator on a weekly rolling over below zero, and that's extremely problematic. So it hasn't crossed its signal line, but you can see the histogram's been declining for a while already, and we need to be concerned. Now here's Brazil. And Brazil is a commodity country, and so it's starting to break through these tops to the downside. And again, big upsloping trend lines for this one's a multi-year one, and we had big outside bars right at the top, which we had last week. And it pulled back, and then we had an outside bar in here that didn't do anything, but nor were we breaking down or up. We just continued to consolidate sideways. And then last week we had a huge outside bar and starting to lose relative strength. So I'm worried about the commodity complex as well. And I think commodities are a great indicator of actual global demand. And when commodities are weak, we should pay attention. Not everybody believes that because they think we've moved on to the service economy and the whatever technology economy, and you can ignore these old basic instruments. I think they're still very helpful for world markets and can help keep us in tune with what's going on. Anyway, copper got right back to its neckline here. And sure enough, where did it struggle? Right at it. And so we had this topping structure, fell down, tried to rally in here, got back up to this neckline that's been important going all the way back to 2013, and then had a really tough week last week. So it looks to me like it's rolling over right near zero. And you can see all through this downtrend in 2013 to 16, it was rolling over. Now, that doesn't I mean, obviously the US market went up in this period, but we should remember that the Fed was on quantitative easing and it was QE infinity, not QE tightening. So steel chart, same thing, rolling over at resistance. Steel is delivered a lot to the oil patch. They're one of the biggest users of steel, and that's rolling over. So I'm concerned about oil. So here's the oil industry, and you can see back in 2015, oil topped in 2014, came down. The XOP started to break down again. And here we sit right here. Now the question is, do we break out from here? And if so, we try to see more demand for steel. So I would just say there's a big trend line in momentum here that I'm watching closely, and if that starts to break, I might change my tune. But to me, it looks like it's going to roll over because it's been declining for 3 or 4 weeks already, and I'd be much more concerned. So anyway, getting on to all of these, I still like the railroads, and the railroads are one big economic indicator for me. So that's one thing holding glue together that I could be convinced that there's still more upside left in the markets. And then I ended the article with a thought on gold, and it looked to me like GDX was going to start to break through this downsloping trend line, and the Japanese US dollar starting to surge up, which is usually, you can see they track each other pretty good, gold and the Japanese yen. And the PPO was turning up just above zero here, so that's pretty bullish. Okay. The problem I have with all of this is, so then on Twitter, there was a large discussion over the weekend. A lot of people mentioned, well, it's the spread between the 10-year and the 30-year that matters, and it has to go below zero. And when it goes below zero and then rallies up from that point, that could be a signal. So we got down to 0.1, and that makes it a good question. Do we have a rally, or do we have enough of a rally in the 10-year, the 30-year minus 10-year spread to actually create this recessionary environment? And the one point I will note is in 2000, so here's the individual markets. So we've got North America, Europe, and Asia represented on this chart. But the idea being, here was the rally in bond yields in 2000 or in 1990, and what we saw was the Nikkei was falling away fast. The S&P basically went sideways for years, sideways to down. These look small now, but they were pretty big at the time. And Germany had a pretty tough time as well. And then obviously we had the big tech boom where the internet started to take off and everything was rocketing higher, and telecom was everything. And it was this big global push. Well, in 2000, what happened was the interest rates actually, this spread got down well below zero and then rallied out of this hole. And you can see this really uptrending move here was pretty important. Now, there was a small one in 1995. What you'll see was the Nikkei was pulling down, the DAX was going sideways, but the US market literally exploded to the high side, and that was really the whole internet companies coming on, Amazon and Global Crossing and all of those other great names from that period. In 2006 and 7, we started to rally out of this hole. I think one of the things I'm noticing on the chart was the steepness of this ramp coming out, where the 30 to the 10-year actually explodes out, the spread widens. And as the spread widens, that seems to happen during all of these recessions. Now, the big question is this 1995 one, where it rallied up for a period of time, and it actually would have had the same sort of look as this 1990 to 1992 period, but instead what happened was we had a big bull market rally. And it was while we were testing major tops from the year 1994. So if there is any kind of correlation to the bond market and the recessions, I think the one place that all of the signals I'm looking for showed up in 1995, and we didn't have a recession. But the other ones were all very good indicators of why you should be cautious. So 3 out of 4 ain't bad, as Meatloaf would say. So we have this situation where all of these are kind of really good examples of why at least to be cautious. And we have this big downtrend right here setting up on this spread, and we'll see if that matters. You know, I can't draw that downtrend line on any of these other ones. I guess maybe a little bit on the 1991, but not in 95, not in 2000, not in 2007. So I'm not sure that the trend line on this matters a whole bunch. But to look at the chart just generally, it just suggests a lot more caution. Okay, the one other thing that we started to see this week was we had more data from the home builders, and I'm just going to go down to my recession watch chart list that I made last week and just show you. So housing family starts came out. One of the things that we noticed was we had this push down below the 40, or what have we got here, 30-week moving average, 150 day or something. And anyway, so we were in an uptrend, we pulled back below, we've rallied up, and now we're back below that level. So that's a little bit concerning. And again, momentum is waning quite significantly after holding up for 5 years. In these previous examples, 0 was a great place to expect a bounce. And if we look at the 1990 recession, it went below 0. 1980 was the interest rate top. So I have trouble using the periods from before that because we had a lot of inflation going on and interest rates were rising into all of this, and then this marked the change there. So even if we cut the data at that point, we really had the 1990-91 pullback, the year 2006 pullback. The year 2000, there wasn't much going on. It pretty much went sideways. It dipped a little bit below, and in 95 it dipped below, but what we did was rolled over. So we're starting to see this where we're below the moving average on this particular indicator. Here's 94, 95, and we dipped below, but that wasn't one. 2000 was one. The bottom line is I think this housing, this lower peak here is concerning, and the fact that we're back below the moving average again after not being below it for almost 4 or 5 years, and we're revisiting it twice within 12 months of each other, probably suggests more weakness. So when asked, what's my positioning? Well, I am definitely getting more bearish as this market struggles to try and make a new rally. And the one thing that I would say is just, be aware of what's going on in the overall markets. And this is our gallery view, and one of our staff members pointed out that you could put 2 ticker symbols side by side, and I think this is extremely helpful because you can compare on an intraday view, and we can see the Russell's breaking down pretty hard this morning. The Dow is still above yesterday's low, but the Russell looks like it's starting to roll over. And you can see on the PPO, now again, this is a 10-minute chart, but rolling over below 0 usually isn't bullish on just about any chart. And here's the Dow, and we can see a lot of red bars are in here, and it's trying to hold above this 200-day moving average. This is a bit concerning. Relative strength starting to wane. These are big companies in the Dow, and these are the small companies on the left. And you can see these are really starting to underperform. They're already back below their 50-day moving average, which is still below the 200, whereas on the Dow, the 50 had gotten back above. But on the daily chart, in both cases, the PPO is moving down towards 0. The Russell is starting to go below. That was not a good sign back in September, October. And here we have the Dow just barely above 0. We're at a really critical inflection point, and I don't think it's time to either call the stock market top or bottom without using some sort of data. And there's enough data still on the bullish side that some people want to hang to those or don't. My point would be try and find the charts that you think are important. I think I've moved way more into the cautious camp, especially with all of the inverse yield information I've taken out, that chart of the 30s minus the 10s, the housing market starting to roll. There's just so many things going on that make me much more cautious. And I still think the bigger problem is in Europe and Japan. So we'll see how this all unravels. But looking at this weekly chart side by side, and again, how did we get there? You go into the gallery view and you can type in 2 ticker symbols side by side, and then whatever you've got set up for your intraday, daily, weekly, it'll post that side by side so you can compare. But look at this kind of triple top structure on the Dow, and what we can see on the Russell is rolling over under the 40-week moving averages. We got red paint here on the elder candles. And, you know, we saw this back in 2015 and 16. We rallied back up and we just briefly started to get some green candles, went red, and then started to slide back down again. So the Russell's back on red candles. We're rolling over below zero, much like we did in 2015, which makes me extremely concerned. And here we are with the Dow rolling over right at zero. So that makes me more concerned. And the point and figure chart, the Russell is just testing its trend line for a bear market. If it started to break through that, we'd start to get more bullish. We're making new lower lows here from the prior column in March. So I think this is a problem, and I think the Russell continues lower. If we go back and use the S&P and just compare these two charts together, I think the bigger issue, so here we're starting to make lower highs, and of course lower lows and lower highs. And on the NASDAQ, we're still holding up quite well. But again, here's the daily chart, and we're starting to get these red candles from Alexander Elder's system and struggling right at resistance. And again, we saw this in a lot of the prior tops as the bond market was making new 52-week lows in yield. And here's the NASDAQ, still no red candles over here, but as you can see, starting to get a little bit more concerning, and the uptrend we had in relative strength from the technology companies starting to look fragile. Again, the S&P really defined topping structure with this big pullback. The NASDAQ doesn't look as bad, but it's because the scale is so compressed because of the big move. I mean, in a couple of years, this thing has almost doubled from 42.50 to 77. Anyway, look at where this PPO is rolling over, right near zero. I mean, if it can continue higher, that's great. But I would say we're at one of those critical inflection points that you don't want to ignore. And, you know, in 2015, the S&P rolled over right near zero. Here we are again with the PPO going flat for the last 4 weeks. So the macro picture for these large caps still looks bullish, and again hasn't changed for the small caps. But that's what's making me more worried, that we're at the right corner or the right shoulder of a head and shoulders topping structure. And if that was to play out, we want to be very, very cautious here and not be overcommitted to the long side. So whether I'm right or wrong, we're about to find out in a really dramatic fashion. But I think more importantly, unless we can start to go back and take out these highs and hold it for a couple of weeks, that would suggest to me that, you know, we've got bigger problems ahead. And I think it was 2940 was our final high. And here we are sitting at 2800 trying to hold that level. I would just suggest trying to be more cautious here until we get resolution one way or the other. So thanks for taking the time to join me on Market Buzz. Market Buzz airs live on Wednesdays and Fridays at 10:30 a.m. Eastern, 7:30 Pacific time on StockCharts TV. You can also catch replays on the StockCharts YouTube channel or on StockCharts TV, which has a running list of technical charting informational shows. Thanks for taking the time to join me. Bye-bye.
Join us April 1st to April 5th to celebrate our 20th anniversary here at StockCharts.com with special guests Arthur Hill, Greg Morris, Gaddis Rose, Martin Pring, and John Murphy. Tune in to Market Watchers Live at 12 p.m. Eastern Standard Time during the week of April 1st to April 5th to help us celebrate.